Predatory lending is any type of lending that exploits people. It's designed to take advantage of people. Many times it's deceptive. The practices will be unfair or abusive. They maybe have high interest rates or terms that are designed to take advantage of people and to get them to pay more than they need to pay, or pay more than what they would otherwise qualify for. In other words, you might qualify for a lower price or a better product, but you get instead a product that takes advantage of you. And usually these products are designed in a way that the bank makes money or the lender makes more money because they get you into a bigger loan or a higher interest rate or terms that are more advantageous to the bank and less good for the consumer. As a general matter, underserved communities are targeted because underserved communities have been denied good loans in the past, so they're ready to say yes. In that sense, they're vulnerable to these practices. But in particular, we know from past practices and we know from history that minority communities, communities of color, are typically targeted, deliberately so, because these are the communities that were historically redlined. That means they were denied the opportunity to get good loans, prime loans. And as a result, the lenders knew that these would be the communities that would be starved for credit, that wouldn't have trusted advisors or friends or experience with banks, wouldn't have a branch manager that they could go to and say, is this a fair loan? Should I do this? And they could be taken advantage of. And that's what has happened over time. It became such a crisis in 2008, 2009, so many people lost their homes, that with the advent of the new administration at that time, President Obama came into power, and there were a number of people who came into positions of authority with the regulators who said, we need to do something from a regulatory standpoint to rein in the banks so these practices don't happen. And a couple of things happened. The first thing, most important, happened was that something called the Consumer Financial Protection Bureau was created. We call that the CFPB. And that, for the first time, was a very serious watchdog agency that was entrusted with the purpose and mission of actually regulating loans. So saying to lenders, if you're going to be in this space, we're not going to allow you to have prices that are going to be too high, the terms that are unfair. And deceptive practices, abusive practices were cataloged, and consumers were forbidden. And a lot of what's called these subprime loans, these riskier loans, were literally outlawed. And as a result, a lot of this predatory lending started to dry up, starting in 2009. Absolutely. There are a couple of things that have happened and have, notwithstanding the improvements that we've had since the CFPB went into effect and some of these regulations went into effect, there have been practices that have continued unabated. One thing that happened is actually been a reaction to predatory lending. Now, what we called predatory lending back then was reverse redlining. And I have to back up a second. Redlining, as I mentioned, is the practice of drawing a circle around an area, usually an area of color, and saying we're not going to make loans in that neighborhood because we think that the people there are not qualified. And typically that was done historically based on race, based on national origin. That happened all over the country. Reverse redlining was a practice that began in the 2005, 6, 7, and even a little bit before that, where lenders actually, it's the flip of the same coin. Lenders said, we're actually going to go to those minority neighborhoods and we're going to target them for predatory loans because they will say yes and we'll make more money. We'll find vulnerable folks there. And so we're going to actually affirmatively target our bad loans there. So reverse redlining means targeting a bad product to a minority community or on the basis of color or race. And redlining is denying a good product to a community of color. And what happened was, when we had this new regulation that stopped a lot of the predatory lending, we had a drying up then of credit generally to minority communities. The reaction of the banks was, well, if we can't do subprime lending, if we can't do these risky loans, than to the minority community. Then what we are going to do is we're just not going to lend there at all. And they went back to doing what they had been doing for decades before, which is focusing on white suburban communities and saying, all right, we'll do good loans, we'll do prime loans in these places, but we think that's where we're going to find the qualified borrowers. So if we can't take the stuff where we make the most money, which is these predatory loans, into the minority community, we're just going to go back to the old redlining practices. So that was one bad reaction. We saw a drying up of credit to communities of color, and that was a big problem. It has been a big problem for the last 10 years. We're still fighting the battles to get good loans into the minority community because we as advocates believe and say, and we know the data shows, there are lots and lots and lots of qualified consumers in communities of color. Of course, we all know that. And banks have a responsibility to find them and to serve them.
Yeah.